Good afternoon, welcome to this week's edition of the video. We've got Bill with us again, and quite a lot to talk about this week.
Really?
Yeah, it's been a good week, but not so good for Turkey.
No, I think one of the things, and again, if you are a relatively new investor, okay, this is the same situation we saw in 97 and 98. It's going to be more widespread now because in 97 and 98 there were only a few developed nations and there were so many emerging markets. But one of the things that we're seeing, and as we saw it yesterday, I mean a dramatic move yesterday, the surprise move by the Reserve Bank of India, okay, then a massive move in interest rates in both South Africa and Turkey.
So Turkey, they put their rates up to 12%.
Unbelievable.
In order to just, stop the flow of money going out of Turkey.
Yes.
So why has that been happening in the first place?
Well, let's go back to, I think there's a term, we started in the States, and you've developed it over here very nicely. It's called shop till you drop.
Right.
And I mean, we're talking about, the countries that are having the massive problems. Turkey, South Africa, Brazil, one or two others. There's a current account deficits. These are the countries, unfortunately, that have gone along for the gravy train and, have been living, quote, outside their means, and now they're having to pay. Now, one of the things, and I know people are saying, well, basically, we're blaming it on the Fed. The simple fact is that the Fed started confusing us back in May on when they were going to do quantitative easing. So you started to see a little bit of the erosion then. When you start, and then, of course, in September, when we knew it was going to happen, in December, which they did, and of course again last night, they did another 10 billion.
So what are the implications of this quantitative easing, which is now slightly lower,
yes,
on emerging markets? Why do they care so much about that money?
Because basically, in one respect, albeit in a very loose interpretation, it's like raising rates, okay? So therefore, what it means is that money will flow into safe havens, will flow into the dollar, will flow into treasuries. And I think one of the things which is very difficult is if you're an academic, the whole concept of quantitative easing, and we go back to that slight problem in 29 and 30 when they started, it wasn't called quantitative easing, but it was basically raising rates. And of course, by eliminating quantitative easing, this was, according to an academic situation, this was supposed to be inflation, but as we see, there is no inflation anywhere. So basically what this is doing is saying, at a time when most countries are still either neutral or possibly still looking to lower interest rates, okay, this would be considered to be basically the U.S. raising rates. And I mean, if you talk to some of the bond gurus, okay, I mean, when you talk to them after the Federal Reserve made their decision in December, I won't give you any names, but there were a number of institutions well regarded in the bond market, okay? 10-year, 3.25%, 3.5%, 4% by the end of the year. Well, the last I looked, I think today, it's 2.72. And you see the same thing, flight to quality into bunds, even flight to quality into gilts, and even into JGBs.
So the people are taking their investments out of Turkey.
Yes.
The currency devalues, and that's where we are here. That's why they're trying to put up rates.
Yes.
Get people to deposit in Turkey.
I mean, the class.
It hasn't worked?
Well, not yet. Anything, it's one of these things, we have to remember, this is a global marketplace, okay? I mean, I don't think I could name 5 emerging market countries, you know what I mean? Everybody is a developed nation right now, and I think that's the difference. And also, as we've known ever since day one, the money flight is a 24/7 move. And I think one of the things, even, we first started seeing, maybe not the same comparison, we started seeing about 2.5 years ago, ETFs in gold funds. Well, no inflation, no war, no concern, we'll start moving out of gold. And then, of course, what we've seen in the past, probably at least a good year, has been the number of emerging market funds that have had I think like $4 trillion or something went into emerging market funds post-Lehman. Well, probably 20% of that has been withdrawn. Now, I don't know what the time frame is, and that will continue to be withdrawn.
And that's not the only bit of sort of slightly bad news in this week's news. There's China's now
Yes.
not growing quite as fast. It's a
No.
lot faster than the rest of us. Is that a big problem?
Well, I think one of the things, let's go back, we probably started 2012, or maybe mid-2011. Well, we're not going to worry about what's happening in the Eurozone and Greece. Hey, the Chinese will bail us all out, okay? Now, it took us probably to maybe the middle of 2013 to say, well, hey, wait a minute, what iceberg on the Titanic? And I think that's what we see in a panic. But I think one of the things that we have to look at is, look from a positive standpoint, okay? I know Airbus published something like last week, it was talking about the growth in China, mostly in reference to improved salary payments, okay? It's 10% more expensive to produce the same airplane in China than it is in France. Now, everybody says, well, but that is, I guess, the reciprocation. Once things start to grow, then people want to make more money, okay? Now, with China, you've got 1 billion people, so to speak. But the key to look at it from a foreign direct investment, or look at the money flows. And I mean, all you've got to do is, we have a discount center called Bicester Village. It's at Oxford, okay? Now, according to footfall, that means the number of people in the physical presence. It is the most profitable shopping mall in the world. In 68% of the last 18 months, 68% of the buyers have been China. So it's a situation where, yes, they're helping us. Who knows what they're doing in the States, et cetera, et cetera. So, yes, from a domestic standpoint.
So rather than us spending just in China, they're starting to spend here.
Yes.
They're helping us out now, and we're helping them out.
And look at like Jaguar Land Rover, okay? Most of their seriously expensive exports are going to China, okay? Rather than going to Hull or Newcastle or Benefit Street.
Yeah, very understood. Should we touch upon Scottish independence and the implications there? With
good riddance. No, I'm an economist. Politics doesn't bother me. I guess my feeling is that it may sound rude. We have too many new countries. I mean, let's look at like the South Sudan. Okay, it's a country that's only really, I guess, natural resource is oil. But is it theirs or is it the Sudan? And a country I used to live in years ago, Eritrea. I mean, their only export is rock. So, it's all very nice that these people are independent, but what are they going to be independent for? And I guess the same thing with Scotland. What are they going to export? Harris Tweed now to the Chinese, Glenmorangie, and, what do you do about the oil situation? So, yes, it all sounds like a good idea at the time, but my feeling is that, if that's what they choose, I do feel, though, we get to the midnight hour, and I would feel that whether it's a close call about, I feel that the no's will prevail. Yeah.
We've had a very big week in equity markets.
Yes.
FTSE's 5% lower since we last spoke. Dangerous times for all, isn't it?
It's a good time to buy.
Good time to buy.
A healthy correction.
That hasn't seemed, as it came down towards the end of last week, there seemed like a good buying opportunity, and it's only...
Well, I think probably what you saw was, if we can remember back to Friday the 10th of January, when we got the December non-farm payroll numbers, I think the Bloomberg consensus was plus 197. Okay, it came in at plus 74. Well, you saw, not so much then, but the following Monday, Tuesday, we saw a very, if you listen to most, whether it's CNBC or Bloomberg or CNN, they were all saying, this is a healthy correction. Now, what we're seeing now is a continued healthy correction, but I think we've talked about this before, we're seeing a shift. Look how hot Apple was. But the other day Apple was off 8% at the close of business, or off to 6%. Now, is it profit taking or whatever? But I mean, I look at it in a situation like Warren Buffett. Okay, when people are afraid, that's when I buy. When everybody's buying, I become afraid. And I think what you're seeing is a shift away. I mean, several stocks that I have looked at, have owned in the past. Now, one of them is a company called Plus 500. Well, Plus 500 was off, I think, 16p the early part of the week, which I bought, okay? It's now from where I bought it, it's up 24p. Okay, and so that's what you look at. The company hasn't changed its philosophy. I still like the philosophy of the company, but if I could buy it at a cheaper level, and I mean that's what Warren Buffett does. Okay, whether it be Coca-Cola or American Express or railroads, etc., etc. And I think that's one of the things that we're looking at. But we're also looking at a shift. Okay, what was hot last month or last year may not be hot now. And the simple fact is, I also think that, excuse me, right or wrong, you know, the market now is looking towards next Thursday, ECB and Bank of England, okay? Back on the 22nd of January when we got, you know, the unemployment picture here, right? We had 167,000 jobs. The market, when we finished that day, the market was implying about a 40% probability that the Bank of England would start raising rates in the fourth quarter. Now, twice, most recently the other day, when Carney was in Scotland, saying, hey guys, this is just a threshold. I'm going to eliminate forward guidance. This is just something to look at. And also, if you look through the unemployment numbers, 74,000 of those jobs were state agents. Yeah. Now, one of the things you look at, yes, the UK economy is improving, but most of this is real estate values here in the UK, low mortgage rates. But if you look at productivity, okay, we're still, we're 1% below the pre-Lehman Brothers. So the simple fact is we're improving, but productivity is not. So what we're seeing is the improvement is an increase in the employment picture, but not an increase in real wages.
Yeah, business investment's not as good as it expects it to be, nor is, what else have we got?
I mean, you saw that today with mortgage approvals. Yes, they were up 29%, but as you just said, lending to small business.
This economy grows based on people having supposedly greater wealth because of house prices and just not being disciplined with their savings and spending.
And I mean, you know, even looking at the ECB, I still feel we'll get another 10 basis point cut by the ECB. It may not be next week, it may be March. But I mean, even last Friday, okay, the swap rates were implying a 16% probability that we would have negative inflation by October, okay? So this is, to go back to briefly answer your question about the emerging markets. Excuse me, the global problem is now deflation everywhere, okay? And that's very difficult to work on, okay? Because central banks, you know, have inflation targets. You know, I haven't seen one central bank that quote has a deflation target.
Okay, let's just finally end up on the FOMC last night.
Yeah.
It was all expected, nothing really happened as a result. Anything to take from it though that was mentioned?
Not really, because Janet Yellen basically will do the same thing that Bernanke did. She may be able to, quote, confuse us less. I think she'll be able to solidify what she's doing. Now, already this morning, and this is very briefly, you know, they're already talking about, you know, when Greenspan retired, which will be 8 years ago tomorrow, okay? Everybody thought he was the guru. Now he's been tarnished. So now is it going to be a situation 2 years, 3 years from now? Is it going to be, well, look what Greenspan and Bernanke did to the global economy? And I think this is very difficult, and these are my last words. Right or wrong, the Fed Reserve's responsibility is to the United States. The Bank of England's responsibility is to the UK. They have to basically run a policy that works within the framework of the country. It's unfortunate that, you know...
Without worrying about the rest of the world.
Yeah, it's unfortunate that, you know, the dollar still is the...
Yes, okay.
And one thing we can talk about next week will be the renminbi, if anybody wants to. I've got the credit. But let's don't discuss bitcoins.
Okay, great. Well, thanks very much, Bill.